for the introductions, management accounts are now providing operation manager that result in decrease in productivity because the system fails and distract them from notice key factors and importance for product efficiencies. The system fails because they fail in providing accurate costs, which the methods that they're using basically bias and distort the product cost at individual product level. This will make a dangerous opportunity for misguided decisions on the product itself and responses to the rival product. Usually, financial account system will treat cash outlays as expenses, even if it will benefit the future. Managers that under pressure in meeting short-term profits and need to increase in investment for long run as they need to reduce the expenditure. Management accounting nowadays provide a misleading target for managerial attention, and they fail to provide relevant measures which reflect to the company. However, return on investment will help many companies as it is the only measures of success. Next one is the challenge. The first one is the global competition. We have a very rapid progress in technology, wide fluctuates currency rates, and more. Organization management accounting system must provide accurate info to facilitate efforts that can control costs and measure productivity. They also need to report accurate production costs so the pricing decisions and responses to the rival can be made with best possible info. Secondly, management accounting serves as a vital two-way communication link between senior and subordinate. This is where the senior will communicate with the subordinate so that the goals and objectives will be decentralized between them. The system will be the channel so then the product performance can get reported to the upper levels and the decisions will be seen. Thirdly, success is depend on the product that meet customers' need and efficient production distributions. Ineffective systems still can undermine the best effort in production. However, when it is ineffective, the best outcome occurs when managers understand the irrelevance of system is the opportunity. There is increased demand for managerial accounting systems that occurs when the costs for collecting, processing, reporting, and analyzing have been decreasing. Many production processes can be recorded for analysis of operating performance. Every transaction can be captured for subsequent analysis, while the automated parts recognition provide work in progress. So, assistive systems accurately measure the resource demand in a diverse product line. Timely managerial performance can be computed through the organization. Today, systems can use sophisticated electronic technology to devise reporting and control systems more accurately and timely. However, these simplified procedures used would be costly and timely. Next is management accounting roots. Historians have demonstrated that accounting reports have been prepared for thousands of years back. Demand to record info on commercial transactions have existed for as long as people traded with each other. Before 19th century, virtually all exchanges occur between owner and individual that not part of the organizations. Then, Industrial Revolution happened where ability to achieve gain through economy of scale. On 19th century, they commit significant sums of capital to production process. It is in order to gain max efficiency, so they hired workers on long-term basis as it is better than need to bear the cost of continual spot contract between the labor market. Early account management measures simple but serve the needs of owners and managers so that they will focus on conversion costs and produce summary measure. Goal is to identify the cost for the intermediate and final product and provide benchmark to measure the efficiency. Effect will make the management accounting info provide a substitute for the market price that absent.
To record information on commercial transaction has existed for as long as people traded with each other in the market exchange for 500 years ago. Transactions occur in the market and measure of success were easily obtained. Because of the Industrial Revolution and the ability to achieve gain through the economies of scales, it became efficient for 19th century enterprise owner to commit significant sum of capital to production processes. In order to gain the maximum efficiency from their capital investment, owner hire workers on a long-term basis rather than bearing the cost and risk of continual spot contract. competing in the labor market. The long-term viability and success of this managed organization reveal the gain that could be earned by managing a hierarchical organization as opposed to conduct all business market transactions. The emergence more than 150 years ago of managed hierarchical organization created a new demand for the accounting information. A demand arose for measures to determine the price of output from the internal operation. The earlier management accounting measure was simple but seems to serve well the need of owners and managers. The focus on conversion cost and the summary measure. The measure cost included livelihood and natural and involved some attribution of the overhead cost. The goal of this system was to identify the cost for the intermediate and the final product of the firm to provide the benchmark to measure the efficiency of the conversion process. By the middle of 19th century, great advances in transportation, especially on the invention of the railroad and the telegraph, provided further opportunity for gain to large hierarchical organization. This enterprise could now coordinate the acquisition of raw material and the distribution of the final product of a much larger geographical area that had previously been possible. But without corresponding increase in the quantity and quality of management accounting information, this organization would have not been able to capture the full potential gains from increased scales of operation. Effective management accounting system would necessary to coordinate efficiently the logistical, conversion and distribution activity of this enterprise and to provide summary measure of performance for the centralized and dispersed managers. Perhaps the best example of effective management accounting system could be found in the Railroad Corporation of the mid-19th century. At the time, they were the largest enterprise ever created by men. To oversee their diverse and dispersed operation, new procedures were invented to control the receipt and disbursement of cash. Improved transportation and communication combined with economy of scales also permitted the growth of large distribution enterprise, particularly retail store chains. This organization require information on the effectiveness and efficiency of their purchasing, pricing, and retailing activities. For this activity, measures such as gross margin by department, selling revenue less purchase and operating costs, and inventory stock turn were created. Management accounting measures were designed to motivate and evaluate the efficiency of the internal processes. There was little concern with measuring the overall profit of the enterprise. This organization really had only one activity they had to do well: converted raw material into the single final product, such as cloth or steel, move passengers or freight, or resell purchased goods. If this basic activity were performed efficiently, then the organization could confident that it would be profitable in the long run. Thus, management accounting system was created to promote efficiency in the key operating activity of the organization. The final development in management accounting system occurred in the early decades of 20th century to support the growth of multi-activity diversified corporation.
All practices for management accounting, such as accounts for labor, material, budgets, has been evolved to provide informational and control needs for the managers in complex organizations. But the practices seem to be stopped in mid-1920s. Years by years, products need variety and increase in diversity. Besides that, complexity in manufacturing process also inclined, so companies need to have accurate product cost and effective process control in order to meet the demand of organizations' management accounting system. Trends in competition, technology and management demand able to make major changes in the way organizations measure and manage the cost and how they evaluate short and long-term performance. This is why when the evolution of management accounting system do not align with the process of technologies in product nowadays, it will lead to problems such as distorted product costs, delayed and highly aggregated process control information. Demand for audited financial statements increase as the public ownership of corporation securities increase, and they insist that information in both financial statements need to be based on the same transaction events. Simple methods we use to assign direct and period costs to products. In principle, in the 20th century, managers do not have to yield the design of their cost accounting systems to their financial accountants and auditors. Thus, the decision by managers to not invest in management accounting system separate from those already mandated by the demands for audited, periodic financial statements may have been the correct economic decisions. The benefits from a more accurate and more responsive management accounting system may not have been worth the cost of maintaining such a separate system. Over the years, however, as corporations' product expanded, as production technology changed, as product life cycle shortened, as global competitive conditions shifted, and most importantly, as great advances in information technology occurred, we should have expected a reconsideration of the decision to not invest in more relevant and more timely management accounting systems. In fact, when cost systems become automated on digital computers, starting in the mid-1960s, the system designers basically automated the manual systems they found in factory. If academics were led astray by focusing too narrowly on a simplified model of firm behavior. 60 years of literature emerged advocating the separation of costs into fixed and variable components for making good product decisions and for controlling costs. Nor did the academic researchers attempt to implement their ideas in their environment of actual organizations with hundreds or thousands of products and with complex multi-stage production processes.
Consider a Venetian investor who acquired wood produced in northern Italy and chartered expedition to sell the goods in India. Once the wood was sold in India, the trader purchased tea, traveled back to Venice and sold the tea. At the end of the expedition, the accountant subtracted the cost of the caravan and the cost of acquiring the initial goods of merchandise from the revenues receiving from the sales of tea in Italy to compute a profit for the entire trip. A profit to be subtracted among the investor in venture. This was a worthwhile rule for accounting to compute the overall profitability of the venture and to distribute the net profit among the initial investors. Because even in early unsophisticated days of accounting 500 years ago, investors understood that allocating the total profit of expedition to period of short as 3 months was not meaningful exercise. Arguing that it is meaningless to allocate project profitability to short time periods within the life of a project does not imply that we believe it fruitless to attempt to obtain valuable indicators of short-term progress. Returning to our Venetian expedition, there are probably many measures of the caravan performance during the third quarter of 1487 that the investor would be interested in knowing. There are many potentially useful indicators of the caravan manager's performance during the third quarter of 1487, but quarterly profit is not one of them. And given the current competitive technological environment, there are probably many better indicators of companies' short-term performance than its quarterly earnings. The challenges or opportunity for contemporary organization is clear. The technology exists to implement systems radically from those being used today, but this knowledge can be emerged from experimentation and communication.